Well, our next guest says this rally is heading for a screeching halt, but the pain will be temporary. Let's bring in Joe Zidle, Blackstone's chief investment strategist. Joe, it's always great to have you back.
Thanks for having me on.
Jay-Z, a.k.a. Jay-Z.
Happy to see you guys. Thank you.
So earnings will be the temporary halt to this rally. Why?
I think that's right. And I think we're about to enter this tug of war where so far, markets have been propelled by central bank liquidity, easing conditions from, the ECB, the Fed turning very dovish, China's central bank, et cetera. But on the other side of that, and I think this is the wall that we're going to run into, we're suffering from really slow earnings growth right now. And it's about to become apparent now that first quarter earnings season is beginning. And basically, you're going from 20% EPS growth in 2018 to, maybe less than 5% EPS growth for large cap companies, and small caps are being hit a lot harder. And so I think that is going to create this tug of war where, the gains that we've seen year to date, I think they're going to be very hard to repeat. I wouldn't be surprised to see the markets trade sideways or maybe even down. But the silver lining here is I don't think it's the end of the bull market. I think this is just more like a mid to late cycle pause, because I think we'll have enough time to see earnings recover. But what people are going to have to start pricing in now is an environment where, we're looking at single digit or less earnings growth. Wow.
In terms, your year-end target, by the way, is 28.75, so it's a modest increase from here. In addition to earnings, when you're taking a look at central bank easing around the world, do you feel like we're at a point now where the markets have fully priced that in? They fully priced in this pivot from the Fed. They fully priced in China. And I'm thinking specifically of the Chinese stimulus that was released over the weekend and on Monday. And there's very little reaction in the Chinese markets and in these markets to the additional stimulus. So that sort of begs the question, have we become used to this? Is it all in there?
I think a lot of that's priced in. The Shanghai index being up over 30% year to date, the S&P being up over 15% year to date. It was based on the notion that we would swing from tightening to easing conditions. I think another positive factor, which we shouldn't overlook, is that all that liquidity and easing is going to start translating to the real economy. So we are starting to see data improve, not only out of China, we're starting to see improving data here in the U.S., but even more broadly, like emerging markets, just beyond China, the PMIs in emerging markets, which is a leading indicator, are now higher than developed markets. So I think there is an economic story here that we shouldn't overlook. But again, this short-term tug of war is going to be dictated by all this good news on the economic side versus what we're seeing in the profit cycle, which is just due to slow down, given the fact that we are at, 2017 saw 10% EPS growth, 2018 saw 20% EPS growth. And now, those comps are incredibly difficult.
So if you're talking about low single-digit percentage EPS growth, that must be revenue growth of like 1 or 2%. But don't you think that the investors are going to say it's not what have you earned for the March quarter? It's really more they're going to be looking at the guidance and what are you seeing? And if they're optimistic about that, or are you saying you think there'll be a pause in that guidance even?
I think we could, because let's say, first quarter earnings right now are projected to be down maybe 4% year over year. It doesn't mean that earnings are actually going to be down 4%, because historically the first quarter companies beat by a little over 4%. So let's just say companies beat the way they normally do, and maybe earnings growth comes out flat for the first quarter, like around 0. If the dollar holds where it is right now, it means second quarter earnings are going to be facing a very strong dollar, and that's a headwind to profits, which means second quarter earnings could be pretty difficult as well. But then third and fourth quarter earnings ought to start showing improvement. That's why I'm labeling this a little bit more of a pause. And what happens normally is you've got a profit cycle that works at one speed and an economic cycle that works at another. Sometimes they line up and you get a profits recession at the same time as an economic recession, but they don't always. And I think we're in one of these situations where profits are going to be working at a different speed than the economy. I think we go through a soft patch in profits, but then in the third and fourth quarter of this year or 2020, we get a profits recovery. Meanwhile, I think the economy remains steady and things actually improve. So that's why I would take volatility and use it as an opportunity to be bullish.
Last good question. Why should investors stay invested in the markets right now, given your price target?
Because I think 12 months from now, equity prices are going to be higher than they are today. There's two things that drive drive valuation: earnings and interest rates. And the interest rate picture got a lot better for companies when the 10-year went from 3.25% to 2.5%. Their funding costs have gone way down, and I think that benefits valuations.
All right. Joe, great to see you. Thank you. Joe Zidle.
Thanks for having me.
Blackstone. All right, Dan, what do you think?
Listen, I think it all sounds really reasonable. My view for some time now is that the S&P in particular is trading between this 2,600 and 2,930 or whatever range. And I think the likelihood of breaking out after we've just run 23% in 3 months or so is very unlikely. I just want to make one point that Mike Wilson's been making for a long time. With rates down like that, companies are more likely to manage this earnings recession by buying back more stock. And that could be at the expense of CapEx. And that's when you see this earnings cycle maybe possibly starting to feed into the economic cycle, which could lead to a period of malaise, especially as the market is very range bound. And then you are subject to the sorts of shocks that we had in 2018. We had a January, February down 12%, and we had a Q4 down 20-some%.
I don't think there's anybody here on this desk that thinks that the expectations for second quarter guidance or for first quarter and guidance for the end of the year is going to be positive. Therefore, and to me, right now the pain trade is higher. And ultimately, Joe brings up a good point in terms of the dollar. Year over year, dollar's up 8%, but sequentially, the dollar's done absolutely nothing for 6 months. If the dollar stays here and rates stay here, this market is going to stay here. And if anything, the risk is to the upside.